Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number 1 from Stuff on the 11th of March, more listings than sales, how to sell your house. Topic number 2 from One News on the 10th of March, what will happen to house prices this year? Major bank changes its mind. Topic number 3 from New Zealand Herald on the 11th of March, what to do if you're worried about your KiwiSaver balance. Topic number 4 from RNZ on the 10th of March, are women really more conservative investors? Topic number 5 from Stuff on the 13th of March, summer 2025 marks the flattest housing market performance in 6 years, from QV. So first up for this week in review from Stuff on the 11th of March, more listings than sales, how to sell your house. New Zealand's housing market is showing signs of recovery, but selling remains challenging because of high inventory levels. Although prices and activity are rising, an abundance of listings is keeping price growth in check. In January, the Real Estate Institute reported an average days to sell measure of 54 nationwide and 56 in Auckland, significantly higher than the 37 days recorded in January 2022. That month, there were 3,774 sales across the country, while 8,904 new listings entered the market. The total number of available properties increased by nearly 19% compared to the previous year. In November, outside the holiday period, 11,129 new listings were recorded alongside 7,233 sales. CoreLogic data highlights regional variations in market activity. Opotiki had the lowest turnover rate, while Selwyn and Papakura were the busiest areas. Central Wellington and Central Christchurch saw 3.2% and 4.5% of their housing stock sold respectively. CoreLogic Chief Economist Calvin Davidson noted that Canterbury had shown resilience, maintaining steadier price levels and avoiding extreme fluctuations. Invercargill also remained active due to its affordability. He stated that a typical turnover rate would be around 5%. For sellers navigating this competitive market, property commentator Andrew Duncan emphasised the importance of presentation and accessibility. He advised decluttering and depersonalising homes to make them more appealing to buyers. Additionally, he recommended making viewings as convenient as possible, including hosting midweek open homes, since even a single buyer could secure a sale. Duncan also stressed the need for sellers to regularly review their marketing strategy with their real estate agent. Adjusting listing descriptions, changing featured photos, modifying pricing strategies, or exploring different advertising methods could help attract more inquiries. Real estate salesperson Brooke Gibson highlighted auctions as a way to generate buyer urgency. She pointed out that recent auction sales had exceeded council valuations and predicted that while prices might not surge, market activity would likely increase. I think also another way that you could increase attention to your property is to look at staging or partial staging, because that can just give it the edge over some of the other properties on the market at the moment. So we're still very much in a stable property market. There are more buyers coming into the market, but with the increased number of listings, we've still got a very stable property market across the country, which is great buying opportunities out there. Topic number 2 from One News on the 10th of March, what will happen to house prices this year? Major bank changes its mind. ASB has significantly revised its house price forecast, shifting from the most optimistic outlook among major banks to the most conservative. Previously expecting price growth of over 9% in 2024, ASB now predicts a 3.4% increase this year and 5.1% in 2026. Chief Economist Nick Tuffley attributed this adjustment to sluggish sales and high property inventory, which could delay price recovery. Additionally, declining migration is expected to slow demand. Comparatively, ANZ forecasts a 6% rise in house prices, BNZ 6.8%, Westpac 7.2%, and Infometrics 5.6%. Treasury projects a more modest 3% increase. Infometrics chief forecaster Gareth Kiernan explained that affordability and debt servicing remain key constraints for buyers. While lower mortgage rates and an improving labour market might support moderate price growth, weak net migration could curb long-term demand and potentially put downward pressure on prices next year. ANZ economist Henry Russell described 2024 as a game of two halves. He expects house price momentum to remain weak in the first half of this year due to high inventory levels. Although sales volumes have been increasing, a more significant uplift is needed to tighten market conditions. Russell anticipates a gradual recovery later in the year, supported by improved affordability. Lower interest rates have eased debt servicing costs, and household income growth has also outpaced house prices, bringing affordability back to pre-pandemic levels. However, he does not foresee a price surge in the near future. My thoughts on this are I also am not expecting to see massive increases in prices this year. Certainly wouldn't expect us to be entering into the boom until the economy is much stronger and people are more secure in their jobs. However, none of us have got a crystal ball that works, so it's all educated guesswork. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as a financial advisor and an experienced investor, and these events are all available online, live. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. That's propertyapprentice.co.nz. Topic number 3 for this week in review from New Zealand Herald on the 11th of March, what to do if you're worried about your KiwiSaver balance. Global financial markets have been shaken once again, causing the NZX to open lower. Many KiwiSaver investors may notice fluctuations in their balances. If you're concerned about market volatility, here are 5 key tips to stay on track. Every investor has a unique risk profile, influenced by factors such as investment timeframe and personal tolerance for risk. Growth and aggressive funds tend to experience more fluctuations, but have historically delivered higher long-term returns. Morningstar data shows that these funds have nearly doubled the annual returns of conservative options over the past decade. If you have a long investment horizon, short-term dips are less concerning because there's time for recovery. However, if market swings make you uneasy, a more conservative approach may be better. A financial advisor can help align your risk profile with your investment strategy. It's also crucial to ensure your KiwiSaver fund matches your financial goals. A high growth fund may be ideal for someone with 30 years until retirement, while a conservative fund could be more suitable for those planning to buy a home soon. The key is to align your fund choice with your risk tolerance and investment timeframe. One of the biggest mistakes investors make is switching funds when markets drop, as this often results in locking in losses. This was evident in 2020 when many investors panicked and moved from growth to conservative funds during a market downturn. Westpac data showed that a KiwiSaver member with $25,000 who made this switch in March 2020 would have significantly lower savings in 2054 compared to those who stayed in a growth fund. Timing the market is difficult, and sticking with a long-term strategy usually leads to better outcomes. There are, however, rare situations where switching funds may be necessary. If you're in a high growth fund but need to access money for a house deposit soon, it may make sense to move to a lower risk option, even if it means taking a small loss. In such cases, seeking financial advice can help ensure the right decision. If your investment settings are correct, the best approach is often to stay the course. Avoid checking balances too frequently and allow contributions to continue as normal. Market downturns can even present opportunities. Lower prices means investments are effectively on sale, making it a good time to invest more. Sounds a little bit like the property market. For those uncertain about their strategy, professional financial advice can provide reassurance and help navigate market fluctuations. Research shows that investors who work with advisors tend to get better long-term results and feel more confident during periods of volatility. Understanding how your KiwiSaver responds to market changes can make all the difference. Staying informed, making strategic choices, and focusing on long-term goals will help you weather market ups and downs with confidence. In my experience as a KiwiSaver advisor, I would agree with everything that was said here. And also, I think it highlights the importance of having good international diversification in your portfolio, especially if you're in a growth or aggressive fund, because at the moment, the US share market has been very volatile, but some of the other countries around the world and different regions around the world have still been performing quite well. So that gives a good bit of balance there. Topic number 4 from RNZ on the 10th of March, are women really more conservative investors? Women are often labelled as conservative investors, but this is due to inherent risk aversion, or is it due to external factors? The reality is more complex than commonly believed. Women encounter several financial hurdles. In New Zealand, they still earn less than men, which is horrific, with the gender pay gap exceeding 8% as of last year, about half of what it was in 1998. This disparity contributes to a savings and investment gap. ANZ, the country's largest KiwiSaver provider, reported that its male members had an average of $6,000 more in their accounts than women. While Westpac noted a narrowing KiwiSaver gender gap, it estimated that at the current rate, it would take 15 years to close it completely. This gap is influenced by women's lower average salaries and their tendency to take career breaks, reduce work hours, or opt for lower paying jobs due to family commitments. Women are also more likely to invest conservatively. ANZ revealed that 60% of its high growth fund investors are men, while Westpac reported a similar trend. In February, only 25% of women had some or all of their Westpac KiwiSaver investments in a growth or high growth fund, compared to 27.8% of men. This conservative approach can significantly impact long-term returns. Over the past decade, aggressive KiwiSaver funds have delivered annual returns of 9.3%, while conservative options returned just 4.2%. While it's often assumed that women prefer less risky investments, research challenges this notion. As I would suggest, so does common sense. The New Zealand Society of Actuaries found no clear evidence that women aged 45 to 64 are inherently more conservative investors. Instead, both men and women tend to opt for lower risk funds when they have smaller balances. However, after age 60, women become increasingly likely to be in conservative funds, with a distinct gap emerging after the age of 65. Additionally, research from Griffith University suggests that financial advisors may contribute to the trend by steering women towards lower risk portfolios based on perceived risk aversion. Oh, I can think of one way to avoid that. Talk to a female financial advisor, maybe. This implies that having more female professionals in the investment industry could help encourage women to make a more active role in managing their portfolios. Receiving professional financial advice can make a significant difference. KiwiSaver provider Generate, which integrates financial advice into its services, reported that 55% of its growth fund investors are women. ANZ Investments Managing Director Fiona McKenzie suggested that women's mental load, balancing work, family, and financial decisions may influence their investment choices. McKenzie also noted that while women have been underrepresented in financial trading roles in Western markets, they're prominent in leadership positions in countries like Taiwan and South Korea. Research indicates that women often make excellent traders as they assess risk holistically and are more willing to cut losses, whereas men tend to hold on to underperforming investments in the hopes of recovery. Financial advisor Rochelle Bland, I'm not sure how she pronounces her name, agreed that many women feel too busy managing their households to focus on investing. She observed that while her female clients become strong investors, they often hesitate to ask questions initially. Meanwhile, men tend to display more confidence in financial matters, sometimes to the point of overconfidence, which can lead to poor decisions. To bridge the investment gap, Mackenzie advised women to assess whether they could take on more risk, provided they have a long investment horizon. She recommended focusing on controlling the controllables, such as ensuring KiwiSaver participation, reviewing contribution rates, and selecting a fund that aligns with one's financial goals and risk tolerance. While not every woman should be in a high growth fund, it is crucial to periodically review your fund choices to ensure that they remain suitable. If you were a client of Property Apprentice, you'd get free KiwiSaver advice included in this. And we've got access to a large number of KiwiSaver fund providers that we can make sure you're in a fund that's appropriate for you. Topic number 5 from Stuff on the 13th of March. Summer 2025 marks the flattest housing market performance in 6 years, from QV. New Zealand's housing market remained sluggish over the summer despite falling interest rates, according to the latest QV House Price Index. Nationally, residential property values edged up by just 0.5% in the 3 months leading to February 2025, bringing the average home value to $912,904. QV Operations Manager James Wilson described this as the least active summer in 6 years, noting that the market had stabilised after recent fluctuations. Auckland and Wellington saw modest increases, while Christchurch performed slightly better at 0.9%. Rotorua, Napier and Invercargill led growth at 2.1%, whereas Hastings experienced the largest decline at 3.4%. Wilson attributed the subdued market to affordability challenges, slowing population growth, and an oversupply of properties in some areas. Although investors are considering a return, financial barriers continue to limit activity, while first home buyers are benefiting from reduced competition. He suggested that as long as excess housing stock remains, market conditions are likely to stay flat into autumn. Are you making the most out of your time and resources as a property investor? If you want to overcome obstacles and make good buying decisions, join us at one of our free events online called How to Succeed with Property Investing. These are available live online, so you can gain valuable insights and strategies tailored to today's market conditions from the comfort of your own home. Whether you're an experienced investor or just getting started as a first home buyer, this free session will equip you with the key tools and insights to make confident, informed decisions. Don't miss out. Register today and take the next step towards achieving your financial success. In our free events, I'll also tell you more about how we help our clients to achieve their investing goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today and sign up for one of our free events. If you've already been to one of these and you'd like to know more about how we can help you on your journey, book a no-obligation phone call or meeting with my husband, Paul Roberts, that's free too, through our website, propertyapprentice.co.nz. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing!